G'day, Fools. I'm Scott Phillips, the Motley Fool's Chief Investment Officer, and welcome to another in our, I say it every week, ever popular series, Motley Fool's Stocks in Focus. This is where we bring you the companies that are the most widely known, owned, and talked about companies on the ASX, not necessarily Motley Fool recommendations, but companies we know you're interested in and companies we figure you'd want us to turn our analytical talents to understanding and explaining, plus, as always, giving you some sort of verdict as to whether we expect it to be a long-term market outperformer or whether we think it'll lag the market over the long term from here. Now, speaking of our expert opinion, I bring a particular expert, Mr. Chris Copley. G'day, buddy. How are you?
G'day, Scott. I'm doing very well, thanks.
Excellent. Good, man. Now, no pressure, mate, but I built you up, so there's better... No, I'm kidding. But we are going to talk about one of the... It's got to be... If I was going to guess, I'd say behind the banks and Telstra, possibly the most widely owned company in Australia. Of course, if you already know, it's Woolworths. The company code is WOW. So backstory, I used to work at Woolies when I was going through uni. For a short period of time, I also worked in their head office in the liquor department. Some would say that's appropriate, some would not. And so I have a little bit of a background with Woolies. I used to own shares as well. I was there when they were the fresh food people, and now I should have started with, hey, we want to talk about stocks we like, so that's why I picked Woolies. Oh, there you go. That's their current slogan, which I think is horribly tortured, but I'm not a marketer, nor am I in their marketing department, so that's up to them. Mate, we're going to talk about the Woolies of today, but before we get to that, let's talk about the Woolies of the last 12 or 18 months, because it's COVID's a weird thing. It's thrown all of our usual kind of, I want to do media appearances. I've got this sort of stock, and maybe I shouldn't have stock answers, but I've got their stock views and things where I say, boring businesses, slow growth business, like Woolworths, I normally say. Except the last 12 months has been anything but that. When I talk about businesses that are, reliable income generators, I say, Sydney Airport and Transurban, they're pretty much recession resistant, almost recession proof. And then, of course, we have COVID and there's no planes and fewer cars. So it's been a funny 12 months, funny 18 months. Of course, there is a much more serious health side. I don't mean to make light of the whole thing, but from an investing perspective, it's kind of thrown everything up in the air, a bit 52 card pickup, and we're kind of trying to work out what's what. Woolies has, well, it's not quite a software company, but it's not far from it. The growth for both Woolies and Coles has been phenomenal over the last little while.
Yeah, it has. It's been a very interesting period of time to watch for these large supermarket businesses. So, yeah, in terms of performance, the last couple of years, they've really been supported by the pandemic. So the company saw periods where they were getting record demand for many of its products, as uncertainty around lockdowns are causing people to stock their pantries and cupboards. And the most memorable example of this, Scott's the toilet paper shortage of 2020.
Exactly.
So, the business did have other segments which struggled as well. So it had its hotels business, which saw the opposite, had the headwinds from the pandemic, as a part of its Endeavour Group at the time. But yeah, overall, its performance in the last couple of years have been very impressive. So in FY20, its sales were up around 6%, and this was largely driven by the growth in its food segment. But Big W, which is another one of its brands under its umbrella, also grew sales at a solid rate as well. Profitability did dip in FY20 slightly as the business had to deal with a lot of additional expenses that came with the pandemic to operate during that period. So for example, it had to make things COVID safe. So there were a lot of safety costs that were involved with that. So things like staff overtime payments to cope with the growth in demand, things like cleaning costs, security costs, protective equipment, and the list goes on. So there was a lot of things that the business really had to do to cater for this growth over that period of time. But this investment, particularly in the early stages of the pandemic, really helped the business in the most recent financial year. So sales grew again by another 6% or so in FY21, but profitability rose just over 20%, and they also increased their dividend by 15% as well in the most recent financial year. So these are strong growth results, especially compared to historic growth rates of Woolworths. So, and this sort of growth is by no means something that we think will be sustainable as continued lockdowns meant that people ate out less, and this provided a tailwind for the business, which we don't expect to continue into the future. But what was particularly impressive about these results, though, was that its growth came largely through its online segment. So in 2020, online sales grew by nearly 42%, and a lot of this growth actually happened in the last few months of the financial year at the start of the pandemic, and it was a pretty significant increase and acceleration compared to the 5 years prior. And in 2021, this grew again by another 58%. And the interesting thing about the global grocery market is that online penetration is actually trailing that of most other retail segments. So, in 2019, penetration was a little under 4% of the market. This has grown since the pandemic, obviously, but there's still a long runway ahead. So interestingly, Scott, I know in the past when we've discussed different e-commerce businesses that were really pushing this strategy, we talked a lot about barriers that they'll face. So for example, several years back, many were quite skeptical on the likes of Temple and Webster, for example, being able to capture much market share in online furniture as big ticket items like furniture many thought would be difficult to sell without physically looking at, touching and feeling these products in store. And as it turns out, some of these concerns didn't need to be as strong as they were. As despite those concerns, adoption's grown rapidly over the last few years. There are some barriers to online adoption in grocery as well, but I don't think that they're nearly as high. So, for the vast majority of things that you purchase at grocery shops, we've purchased them before, so we know exactly what we're going to get. So in my mind, as friction's removed from the process and the experience continues to improve, which it will as the company is continuing to invest a lot in building out its e-commerce capabilities and solutions, then I think adoption can really hit quite a high level in this industry. So there are some headwinds that come to mind, though, of course. So it's a real pain, for example, when you order several avocados and a couple that you receive aren't in the best condition if you do it online. So when it comes to shopping for fruit, for example, some still prefer, and this is definitely me, I prefer to go in there and select the items that look good. I might want one avocado that's ripe, for example, that I can eat today, and then a few that I want in a few days' time. And this experience is going to be difficult to replicate online. So it may provide a barrier for adoption in some area of its business. But yeah, overall, I think over time, online will become a larger proportion of its business, and it'll continue to invest in automation and fulfillment centers and other areas of its business as well to help reduce the friction and potentially help improve its margins over the time by reducing our operating costs as well. So yeah, in some ways, Woolworths is positioned for further earnings growth in years ahead. But yeah, that's a bit around what's been happening with the business in the last couple of years.
Mate, it's a really, really strong summary. Thank you. I know for myself, I'm currently in lockdown. We're outside Sydney, but in a regional area that's locked down. Last week, the week before last week, I'm pretty sure it was, you couldn't get an online delivery slot for 3 or 4 days. They were booked out that far ahead. So not only is there probably likely ongoing growth, and again, obviously because of the pandemic, but the more people trial it, as you say, the more the penetration grows, the more people are likely, not the same number necessarily, but once you've started shopping online, you probably like it, you'll probably do it again, or at least from time to time you'll try it. Some people will fall for it entirely. And that's certainly, I would assume this year's, or at least right now, their sales growth online is actually limited by capacity far more than demand. As you already said, 40% growth in 1 year, then another 50% on top of that 40%. That's close enough to 70-75% of the previous year. So these are really rapid rates. And it's one of those stories where I think, as you say, people look towards the pure play online retailers. We like those guys, obviously, but even good old Woolies, who in theory could have been left or caught napping, has been really, really fast with Coles. To be fair, really fast to kind of come to the fore when it comes to bringing together the old world, the grocery shopping, with the new world. And I agree with you. The freshness question is always going to be there. The other problem I have is out of stocks. You kind of order something today, it arrives tomorrow, and you get an email half an hour before saying, "Oh yeah, no, the avocados, yeah, we didn't have any." It's like, oh man, well, if I'd known that, I would have. So there are some ways to go, but they are first world problems for sure. And as you say, plenty of people with full pantries right now, having stocked up. Still a limit of 2 packs of toilet paper in my local Woolies, by the way. So we're not yet past. Well, we're probably past peak toilet paper. I doubt we're back to absolute normal, but at some point, our home's going to be chock full of toilet rolls, and at that point, maybe the Woolies demand will slack off somewhat. Mate, let's move on from there then to where. I mean, I guess yesterday's Woolies is not today's Woolies in a whole lot of ways, and sales to some degree is the least of those. Lots of changes recently.
Yeah, there has been. So, under the Woolworths umbrella, it's not just Woolworths; it's Big W as well, which I mentioned. But there used to be a lot more. So, the business actually recently demerged from Endeavour Group. So, Endeavour Group was essentially its drinks business. So, think the Dan Murphy's and the BWS brands. It also had its hotels segment, which I mentioned before.
Right.
But yeah, despite this demerger, though, I think customers and shareholders should be happy that they will be providing, I guess, ongoing partnership capabilities. So they'll continue to, I guess, see the benefits and efficiencies that were received from the likes of shared supply chains and stores, shared business support, and also loyalty programs as well. So yeah, this demerger has really changed the business in many ways, and it was partially done to simplify the business and allow management to focus more so on its food and supermarkets business. But I think a large part of this demerger as well is due to ESG reasons, so environmental, social, and corporate governance reasons. So it could, for example, help the company be valued at a higher premium than what it may have been before when it had its alcohol business attached to it. It could also potentially give them better and easier access to capital, as some funds actually rule out investing in certain projects that don't meet certain environmental or ethical criteria. So, for example, Woolworths actually only recently priced its inaugural sustainability-linked bond. So within these bonds are yeah, it's an interesting one. So in these bonds are financial incentives for the company to meet certain sustainability and environmental goals. So yeah, so ESG certainly appears to be something that's high on the priority list for Woolworths. So the business releases a number of announcements, and in November last year they released a new 2025 target within sustainability. So it's really pushing its focus towards creating lots of different things. So an inclusive and diverse workforce, it talks about a lot. It talks about its target of 100% green electricity by 2025. It also targets zero organic food waste to landfill, and it's looking to make its packaging more sustainable by removing thousands of tons of plastics from its products as well. So considering the consumer focus of the business and the significant call from consumers as well as investors around environmental sustainability, diversity, and inclusion, I think this is an important factor to mention for the business, particularly from a consumer perspective in mind, because more and more ethical and environmental issues are becoming an increasing factor around consuming purchase decisions. So I think this focus on these matters is an appropriate move for the continued success of the business itself. But yeah, this was the main key change for the business over the last few months, and certainly positions them in a different manner to what they were over the last many years, many decades.
It is a fascinating one, this ESG change. Like you, mate, I see that both from an investment and a consumer angle. It's let's not editorialize too much or get too far off track, but the changes they're making, the consumer-facing changes, the shopper-facing changes they're making, there's really it's a strange thing to see supermarkets, Coles and Woolies, leading this kind of charge towards some of these topics. As you say, green by 2025, no organic waste to landfill. Plenty of these changes kind of being driven by these guys. Even the protests about what was involved in poker machines, for example, as part of that liquor business. You kind of hive the whole lot off, put the hotels over there. All of a sudden, Woolies is now not a pokey business. And again, from an investor perspective, that's to some degree relevant. From a consumer perspective, seemingly increasingly relevant, and trying to position themselves as the best, in air quotes, place to shop for a whole lot of reasons. Obviously price, obviously range, obviously freshness, but a whole lot of other things like those sort of reasons to not choose Coles instead. It's a remarkable thing to kind of see that happening in real time. As you say, it's not it's not the too cool for school brands. It's not necessarily the the funky retailers. It's the plain white bread retailers, Woolies and Coles, who are leading the charge in some of these areas, which is fascinating. It does kind of amuse me to some degree. The BWS liquor that's literally next to the checkouts at my local Woolies store is officially a different business. I think, well, kind of, guys, but you do wonder how much of that is actually required versus just like, let's just get it off our plate, guys. Let's just move it over there. Shareholders got the demerged business, so they still own both. I'm sure, as you say, there's shared business support and other things going on, so that helps as well. So let's move on now to the investment case, mate. Obviously, ginormous business. It must be more than 1,000 Woolies supermarkets around the country by now. Billions, tens of billions of dollars of sales revenue. It is, I joke regularly, it's one of the highest recurring revenue businesses in the country. And we like to talk about software having recurring revenue because they have 90% customer retention. I reckon Woolies has probably got 95%, 99% customer retention, because if you start shopping there, you're probably going to go back at least once in the next month. You might go to Coles as well, but you probably go back to your Woolies. Of course, I jest only a little bit, because these are such dominant, maybe this is why they're leading the charge. They're such dominant parts of our everyday lives, quite literally, whether it's online, in person, the old car boot pickup they're doing now. It is ubiquitous in a way that very few businesses, maybe only the banks and maybe Telstra, but not even then, are. Let's talk about the investment rather than the company. Let's go to, obviously it's a stock market listed investment. We can buy shares or not. That's what we're here for. That's what we do at the Motley Fool. Sell me on it. Create the bull case. Give me some compelling reasons why I should, after this interview, jump on my broker's website and buy some shares in Woolies.
And to just jump on a point you mentioned before, you're talking about the recurring revenue nature of its business as well. And interestingly, I think they have potential to actually improve that. So, for example, the way I use these products now. So at my place, Woolworths is the closest shopping centre. So I go there to do my shopping. But if I'm at my girlfriend's place, for example, Coles is the most nearby. So I do shopping at Coles. But if you have the online option, which actually reduces friction and creates the process a whole lot easier for you, then perhaps I pick Woolworths and go through it every time, despite how close the particular supermarket is to my place. So potentially there's the options for them to actually increase this over time. But yeah, I guess a key reason why Woolworths, I think, is an attractive investment is clear by just looking at its history over the last, many years. So I think the company started back in 1924 when it was just one store in Sydney. And since then, the business has arguably the best and most reliable history of any Australian company over that period of time. So you're being in the consumer staple sector, and just the fact that doesn't matter what the economic conditions are at the time, people need and they'll continue to buy their groceries. So that's one of the key reasons behind why Woolworths has been such a consistent performer. And I think there's a good chance that this will continue for a long time. I think there are also a couple of reasons why Woolworths looks attractive right now. And the first is due to it being a leader in innovation. So the business is creating its first automated online fulfillment centre in Auburn, New South Wales. It also has 4 micro fulfillment centres already in operation around Australia and New Zealand, and it's investing heavily into automation and as I said before, trying to find ways to reduce the friction in the consumer experience. So, for example, right now, the common process in much of our online grocery shopping is we fill out our order. This order is then fulfilled in one of our nearest supermarkets and then delivered from there. So there's plenty of opportunity for significant operational efficiencies through creating a facility which is specifically designed for e-commerce. The second key reason that I really like about the business is just executing. So over the last several years, it's continued to maintain market share in its food business despite strong competition. Its overall revenue growth in its food segment increased by slightly more than its larger competitor Coles in the last year as well, which is a positive sign. And it also recognises the clear opportunity in the expected growth in online grocery sales. So it's been investing towards this for a number of years, and also its growth of 58% in e-commerce sales also outpaced the Coles e-commerce sales during the period as well. So yeah, the business isn't generating rapid growth, but it's delivered solid results, not just from the pandemic, but over the last few years before the pandemic as well. So, for example, if you look back at its dividends, it's trending in the right direction. So in FY17, dividends were 84 cents per share. Then in FY18, it was 93 cents, then $1.02, then back to 94, then $1.08 in the most recent financial year. So it's not rapid growth, but these are solid results, Scott, and they're certainly trending in the right direction. So there are certainly less attractive places to put your money than a business with a reasonable dividend yield, with a strong market position, and a business that's generating modest but relatively consistent growth over time as well.
I like that, mate. And as you said earlier, this is a business with really high amounts of fixed costs, which we don't generally love. What it does mean is if you can get a little bit of growth on the top line, that can be a lot of growth at the bottom line. As you mentioned, 6% revenue growth last year, but 20% profit growth. So it doesn't need all that much. Yes, it's going to go slowly at the top line, population only grows so quickly. There's only so many cans of baked beans and I was going to say top rolls of toilet paper. Maybe that is inexhaustible, but the rest of the categories, there's only so much of what we can use. But a little bit of growth there can be a decent amount of growth in the bottom line. Okay, so solid, stable, dependable, growing business. I like that. Now convince me not to buy the shares. Why should I avoid Woolworths?
Yes, well, like every other business on the market, it isn't risk-proof. So, even in its long and impressive history, there's been a few stumbles along the way. So, firstly, there's lots of competitors. So, there's Coles, Aldi, IGA, Costco, a few of the key ones that come to mind. And every now and then we see price competition that eats away at margins and impacts profitability. So, that's something to always keep an eye out for. We're also seeing the rise of a new type of food provider. So the online meal kit delivery businesses, so the likes of your Hello Freshes and your Marley Spoons, for example, and these sorts of providers, whilst they can come at a bit more of a premium price for customers relative to just purchasing groceries online, many argue that these sorts of services are just more convenient. And I've used some of these products in the past as well, Scott, and I certainly recognise the convenience. Firstly, because I'm not a very good cook, so I use it as a way to learn new recipes and honestly just cook better food, which is great too.
Yeah.
It was also convenient in the fact that I didn't have to spend time coming up with recipes or going to the shops to pick up any last minute ingredients I hadn't thought about. And there was also no food wastage as well, because they give you the exact amount of ingredients that you need. And if I was super into health and fitness, so it would also be an easier way for me to track my calories and food intake as well. So Woolworths was actually, interestingly enough, one of Marley Spoon's largest investors for quite a while, though it did recently sell its shares in the business, and it may eventually move more into this space itself as well. And it wouldn't be the first supermarket giant to do this either, as Aldi created its own meal kit offering earlier this year too. So this is certainly a space to watch out for as it's growing rapidly and evolving quickly. Another key risk for the business is that the company could also potentially make poor capital allocation decisions. And we've seen this several years back. So when Woolworths was trying to compete against the likes of Bunnings through its Masters hardware business. So this ended up being a failed venture, and it ended up costing investors quite a bit. Its share price during, I think it was the 2016-17 period, it might have been just before that, dropped a fair way, nearly 50%. So, and the business also mentioned since its demerger that it's also looking out for complementary investments and ways to add to its product portfolio and solutions portfolio as well. So if capital allocation decisions in this regard's done poorly, then that could impact the share price as well. So investments risk-free, and there certainly are things to think about when it comes to Woolworths as well.
All right, so as usual, you guys lead me up the garden path and convince me to buy a stock, and then you turn around and completely dissuade me. I'm not sure where to sit. So I'm going to ask you, with a lot of theatrical pausing and build-up, do you think over the next 3 to 5 years and beyond, Woolies are likely to beat the market or lag the market? And before you answer, I'm going to add to the suspense, but just reminding our viewers that if you can't beat the market, you can buy the market. You can buy a really low-cost ETF from Vanguard or somewhere else and get the market return less a tiny little bit of fees. And so if you can't beat the market, why would you? And more importantly, if you're going to try and beat the market, but you're buying companies that won't or can't, then you're actually handicapping yourself. You could just go and buy, as I mentioned, that ETF or some shares in something that's going to beat the market. Now, there are some people who might be investing for income, and that's a different question. But generally speaking, if you're investing, we think you want to be at least able to match or beat the market or buy the ETF. So given that's our bogey, Chris, that's what we're aiming for, can Woolies top the market performance, or is it destined to lag behind?
Yeah, I don't think that Woolworths is a market beater from here. And the key reason behind that is just because of the nature of the business. So it already has a clear, strong position in a market that's only likely to grow at a slow rate moving forward. It's a stable and less risky investment than many other prospects. And investors know this, which is why they're happy to pay a higher price for an investment and just expect to likely get a slightly lower than market return. So if you look at some of its valuation figures as well, so with a $1.08 full year dividend, this puts its dividend yield at around 2.7% fully franked. So this is it's a reasonable dividend, but it isn't particularly strong. And it also doesn't take into the account the tailwinds from the pandemic, which have supported the result over the last 18 months as well. So, the years ahead, as things start to open up and we return to eating out more, it could could make the last year a more challenging comparative for the business. So it's definitely possible that this current $1.08 dividend may drop slightly in the years ahead as well. And it's also trading at a lofty multiple, so a bit over 30 times earnings. And for a business that we'd only expect to grow maybe low to medium single-digit earnings growth each year, even if things do go right, this is a pretty high price to pay for that sort of business. So yeah, this doesn't necessarily mean that it's a bad investment from here, but if your goal is to generate a market-beating return, then I think that Woolworths shares would be unlikely to do this over the next 5 to 10 years or so.
There you go, Fools. A very thorough summary from Chris explaining the business, what it does, how it's changed, and what he's expecting from the future. Like many other retailers in the current financial year, there might be some headwinds they have to sail into just before they get back to business as whatever usual looks like post-COVID. Mate, thank you very much for sharing your time and your knowledge with our viewers. I'm sure they very much appreciate it too.
Thanks very much, Scott. No, I always enjoy the chat.
You're a good man. Thank you very much. And viewers, until next time, until next week's Stock in Focus, or on Monday, Tuesdays, you can grab our favorite investment books. On Wednesdays, you can grab our Stock of the Week. There are podcasts like Motley Fool Money or The Good Oil with Scott Phillips. You can get us on social media. Chris, are you on Twitter at the moment, or have I got you on Twitter yet? You're still lagging behind. Remind me.
Still lagging behind. Haven't got there yet, Scott. Eventually.
There will be a time. There will be a time. I'm going to keep asking you until eventually you're browbeaten. Jump on Twitter anyway, because you can follow me or the Motley Fool on Twitter and Instagram. Same handle at TMFScottP or at the Motley Fool AU. On, the podcast I've already given you. On Facebook, go to facebook.com/the Motley Fool Australia, I should say, or facebook.com/Scott Phillips Money. If you are watching this on YouTube, and you have to be because it's nowhere else, make sure you do hit the like and subscribe button, hit the notification bell so we let you know next time there's something good worth watching. And as I said, there is plenty of great stuff coming up. So on behalf of Chris and I, until next time, Fool on.